But the Fed has never done the right thing. So, why would it start now? I mean, we know what they want to do. They want to do whatever they can to kick the can down the road and to delay the inevitable crisis. And the only way to do that is to print money. That's the only tool they have, right? Is to print money, lower interest rates, print money, and hope that they can, postpone it for a few more years.
In this exclusive interview, Peter Schiff argues that quantitative easing is essentially a euphemism for printing money and buying government bonds, a practice as old as paper money itself. He points out the historical caution against such actions, highlighting the gold standard. Schiff contends that the Federal Reserve's promises of temporary measures have proven false, leading to an ever-expanding balance sheet. He accuses the Fed of avoiding the right choices and predicts an unavoidable crisis, emphasizing their reliance on printing money to delay the inevitable. According to Schiff, the Fed's actions have turned the economy into a monetary roach motel, suggesting a looming and exacerbated crisis in the absence of corrective measures. With that, let's dive into the video to hear his full thesis.
Quantitative easing was just a euphemism. The Fed wasn't doing anything new, right? They weren't doing anything that, the Reichsbank or the Zimbabwe hadn't done, or Argentina. It was just inflation. All they did was print money and buy government bonds. It's not like they invented some new thing, right? It's been done ever since they had paper money. And that's why, the founding fathers put us on a gold standard to avoid this. And in fact, when the Federal Reserve was first started, they did not allow the Federal Reserve to own treasuries for the very reason that they didn't want them monetizing debt. And, when the Fed first launched quantitative easing, and then Bernanke went to Congress, congressmen asked him, they said, hey, you're monetizing the debt. This is not a good thing. And Bernanke said, no, we're not monetizing the debt because this is just a temporary program. We're going to sell all these bonds. We're only buying it temporarily. It's only debt monetization when the central bank buys the bonds and keeps them. Well, that's exactly what they've done. Because when Powell was asked about it, the balance sheet was, a fraction of what it is today. I mean, it's, even though they've shrunk it by $1 trillion, it's still about, an $8 trillion balance sheet. So the Fed never put those bonds back into the economy. Powell lied to Congress, and I called him out. At the time, I said he was lying. I said that, no, there's no way the Fed is going to be able to reverse what it's done because it'll create a bigger crisis than the one that it tried to prevent by doing it in the first place. So I said at the beginning, it's a monetary roach motel. You Fed could check us in, but never check us out. And here we are, over a decade later. And all those bonds, plus a lot more, are still there. And yeah, they're going to go back to quantitative easing. Who cares what they call it? But the balance sheet is going to start to explode because the Fed is going to have no choice. I mean, it does have a choice if it wants to do the right thing, but the Fed has never done the right thing. So, why would it start now? I mean, we know what they want to do. They want to do whatever they can to kick the can down the road and to delay the inevitable crisis. And the only way to do that is to print money. That's the only tool they have, right? Is to print money, lower interest rates, print money, and hope that they can, postpone it for a few more years.
In this next discussion, Peter Schiff suggests that gold has established a strong base above $2,000, emphasizing its potential for significant upside. Schiff notes the historical resistance but believes it is not formidable. He dismisses concerns of downside risk, asserting that gold's pullbacks have been narrowing. Schiff contends that, in the current market scenario with an expensive stock market and rising inflation due to increased money supply, gold is historically undervalued. He predicts that gold prices could surge to $10,000 or $20,000, particularly as a hedge against the impending fiscal challenges. Despite widespread optimism, Schiff urges viewers to grasp the reality of the Federal Reserve's actions and the economic bubbles it has inflated, asserting that a genuine prospect exists for gold to explode exponentially in the near future.
Yeah, I think that gold has built a very big base around this level. It initially rose to around 2,000 in 2011, and then pulled back to 1,000, and then gradually made its way back up again to 2000, and it's kind of been hanging out around this area, and now it's been building a bit of a base just above 2000. And I think we've been, compressing the support higher, and the resistance is there, but I don't think it's very formidable at around 2100 or 2150 or just above. A lot of people are still a little reluctant to buy gold above 2000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest. But, there's not that much interest. And I think the upside potential is enormous relative to, the downside risk in gold from here. I think historically, if you look at, where gold is relative to, let's say, U.S. stocks relative to the Dow Jones, with the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created in the near future. And, you asked me earlier about, inflation. The inflation is all about money. We had a huge increase in the money supply, and that's the source of the inflation. That is the inflation. The impact that has on prices is a result, and we're focusing on prices, and we're not looking at inflation. And that kind of lets the government off the hook for creating it. And, it always annoys me when I watch some of the financial channels and they talk about food inflation or rent inflation. There's no such thing as rent inflation or food inflation, as if landlords cause inflation or the farmers are causing inflation. They're not. Food prices are going up because the government has caused inflation. Rents are going up because the government has caused inflation. The inflation is the expansion of the money supply. And even though money supply has contracted a bit recently, compared to how much it went up, it's barely gone down. And so the prices still haven't adjusted to the money supply growth of the past. And inflation is not just about growth of money supply. It's about credit, because consumers use credit to buy stuff, just like they use real money. And so if credit is expanding and now consumers take that credit and they buy stuff, that bids up prices. I mentioned earlier that credit card debt is soaring to a record high. I mean, look at the last month. It was like 4 times estimates when credit blew up. Consumers are taking advantage of credit that is still plentiful and easy. And they're buying stuff. They're buying stuff that they can't afford, that their 2 or 3 paychecks still don't allow them to pay for. They find a way to borrow the money. And so as long as credit is continuing to expand, that's going to bid up prices, and prices are going higher and higher and higher. But when you look forward to this fiscal cliff and what's going to happen to money supply as the interest rates really start to move up, because nobody wants to buy treasuries. I mentioned earlier, somebody's buying treasuries, but eventually nobody's going to want to buy treasuries. And everybody who owns treasuries is going to want to sell treasuries. And that means the only buyer is going to be the Fed. But it's not just going to be treasuries. No one's going to want to buy any US dollar denominated debt, because none of the borrowers are going to be able to pay rates high enough to cover the loss of value of the dollar. So then the Fed might have to start buying municipal bonds, corporate bonds, everything, and it's just a spiral. And so it's not just that we've had so much inflation in the past, but that we've got so much inflation that's already baked in the cake for the future. That's why the price of gold really needs to start to rise. to reflect that. Right now, people just don't get it. I mean, people are still optimistic. They're still confident in the Fed. They still don't understand, what's about to happen because they don't understand what already happened. They still don't, know, how the Fed created all these problems, how it inflated all these bubbles. They still think we have, genuine prosperity as opposed to a gigantic bubble.
In today's discussion, Peter Schiff delved into the risks of quantitative easing, highlighting its potential impact on the economy. He underscored gold's historical significance as a hedge amid financial challenges, suggesting a potential surge in its price. Schiff outlined the Fed's reliance on printing money and purchasing bonds, paralleling historical monetary practices. Expressing skepticism about the Fed's ability to reverse these actions, he warned of an impending crisis, labeling it a monetary roach motel. Shifting to the gold market, Schiff noted a significant base around $2,000, emphasizing favorable conditions for upward movement. He urged viewers to consider gold's historical undervaluation, especially compared to an expensive stock market and the specter of future inflation. Stay informed on these economic insights. If you found this valuable, don't forget to subscribe, like, and share your thoughts in the comments below.